Hi, good people. We welcome you to today's webinar. This webinar is in partnership with Scope Markets Kenya and Sylvia's Traders Lounge. And so we shall be starting in a few. Let's give people a few minutes to join in, and then we will get started. The webinar will be streaming live also on our YouTube channel. So we're giving people a few minutes to join in, and then we will start. As we wait for people to tune in, the topic for today's webinar is Risk Management 101 for beginning traders. Thank you all for tuning in. We're still giving people a couple of minutes before we start today's webinar. Also, if you have any questions during the webinar, please feel free to type them in on the Q&A section or in the chat section, and then we shall be answering them towards the end of the webinar. All right, guys, I see it is exactly 2 p.m. and people are streaming in. So let's give them like 2 more minutes and then we will start, just being fair for the people who tuned in a little bit earlier. 2 more minutes and then we can start. Thank you, James Minor, for raising your hand. Please feel free to type in your questions as the webinar progresses on the Q&A section. Once we begin the webinar, and we shall answer your questions towards the end of the webinar. All right, so let's officially begin this webinar. Once again, thank you guys for tuning in. My name is Sylvia Mushai. I will be taking you through today's webinar, and I will begin by sharing my screen for today's webinar presentation. And perhaps before we start, I will give a quick disclaimer that the information being shared in today's webinar is for education and information purpose only. It is not investment advice. And so please bear that in mind before we begin. All right, so as mentioned before, this webinar is in partnership with Scope Markets Kenya. Scope Markets Kenya, as you know, is a licensed brokerage firm operating in Kenya. And so today's topic, as seen, is risk management 101 for beginning traders. And we will cut across three major topics for today, and that is capital preservation. We will also talk about position sizing, and we will also talk about the place that trading psychology and risk management comes into play. So what is capital preservation? Capital preservation for traders is basically protecting your trading capital. We know that for you to be able to trade in the financial markets, you need access to capital, that's number one. And you also need to manage that capital, number two, for you to be able to survive in the markets long term. So from that photo there, you can see some dollars locked in. And basically what that image illustrates is for you to be able to become a trader for the long term, you should be able to have the skill set to know how to manage that capital, and so that it doesn't deplete from your trading account, because then if it depletes from your trading account, then you have no business trading. So capital preservation is the lifeblood of trading, without which there is no business. So like any business person, any businessman or any businesswoman, you need access to capital, and you need capital to be able to do your business. So it is no different in the trading business. So for you to be able to preserve that capital, then you need the risk management tools or the risk management modules for you to sustain your trading capital. Basically, that's why we call it the lifeblood, because then when your trading capital is depleted, then you cannot be able to trade. Unless you're on a virtual trading account, which is a demo account. All right, number two, all trades executed will be a combination of winning and losing trades. And by the way, these concepts that I'm introducing to you, and I'm assuming we have a combination of both beginning and seasoned traders. These are factual statements in the trading industry, and you're welcome to ask any questions, but these are factual statements that you can also look up later, and I will give reference to books perhaps that you may read on. as the webinar is ongoing. So all trades executed will be a combination of winning and losing trades. I'm sure some of you in this webinar have live or demo trading accounts with Scope Markets Kenya. So when you go to your trading account and you look up your profit and loss statements, you have a combination of winning trades, and you also have a combination of losing trades. Basically, when you execute on a trade, it can be a winning trade or it can be a losing trade. So you need to understand that from the get-go. Before you go into a live trading, for instance, or even before you go to a virtual trading, you need to understand that all your trades will be a combination of winning trades and losing trades. Now, the key is to ensure that the winning trades are more than your losing trades in a given time horizon or in a given holding period for you to be a profitable trader in the long run. So what does that mean when I talk about winning trades should be more than your losing trades for you to be profitable? Essentially, if you're doing a business and you've been doing a business for, say, 5 years, give or take 5 years, you have already mastered the art of doing your business, whatever business it is. If you're opening up your shop today in the morning and you're selling, say, tomatoes to your retail customers, at the end of the day, you book in your profit that you have registered for that particular day, for instance. So it is the same in the trading industry. You come into the markets. If you're a short-term trader, if you're a day trader, for instance, that means that you open and you close your positions at the end of the day or when the market closes. Then no matter the amount of trades that you have executed in that day, what your goal will be is to ensure that your winning trades, for instance, are more than your losing trades, because you are in the business of making money, right? You are in the business of making money. Essentially, as a trader, that is your end goal. So whatever time horizon or whatever your holding period is, if you're holding your positions for, say, a week, right? If you're holding your positions for, say, a week, it means that at the end of that week, when you're doing your evaluation, you would be looking to have your winning trades more than your losing trades for you to be net profitable for that particular week. Again, if your holding period is a month or 6 months or in 1 year subsequently, you want your winning trades to be more than your losing trades for that particular time horizon. And that is how you become a profitable trader, okay, professionally. You should note that without the trading capital, you cannot trade. That goes back to the earlier point. And that trading capital is the fuel to move you from one point as a trader to another. So on that note, as a trader, we do have our own individual trading journeys. All right, so that trading journey may be from, say, year 1 to year 2. It can be year 5 to year 10. It depends on where you are at on your trading journey. And so when it comes to the capital that you're using to trade, it means that you need to sustain that capital for that particular time to sustain you for however long that you are on that trading journey. So this goes back to the point of you realizing that without that trading capital, you really cannot trade. So for beginning traders, it is highly recommended that you start with a small and a sizable amount of trading capital. Okay, so say this is the first day that you will open your trading account with Scope Markets Kenya, and you want to trade and you want to test the waters in a live market environment. It is highly recommended that you start with a sizable amount of capital that you can afford to lose. Say, for instance, $100. That's 10,000 shillings thereabout, depending on the exchange rate for today. So we normally say that in trading, do not put in capital that you're not willing to lose. And especially when you're starting out for a beginning trader, we say that when you're learning how to trade and you have more losses or more losing trades than your winning trades, just take that as market tuition, or rather, it is the lessons that you're learning as you master how to trade. And mastering how to trade is denoted by your risk management tools. Okay, so basically, do not put in money that you cannot afford to lose. And especially as a beginning trader, and you will realize this from most people's trading journeys, not only from STL or from every professional trader who has been in the markets, every professional, and I will insist, every professional trader who has been in the markets, most people started out by losing their trading capital. And we say that is the cost of tuition. However, if you learn the concepts that we're introducing in this webinar for today, which is risk management, then you will be able to lessen or make the lessons, the cost of tuition, less, because you're going to be applying these risk management tools that have a mathematical edge for you to be able to have more winning trades than you're losing trades. Okay, so up until that, I hope it's clear. And then you should be very cautious when you're taking advantage of leverage. And I will explain what leverage is and even give an example. So leverage is basically borrowed capital. Borrowed capital is, or you can also call it debt equity. So for instance, if you open your live trading account today with $100 and the broker gives you access to leverage, sure Scope Markets have also a leverage ratio of from 1 to 400, I think. Yeah. So the broker gives you access to leverage, which is debt capital, which is money that you do not have in your trading account to allow you to trade bigger positions or bigger volumes, for instance. So if, for example, and I would like you guys to take like a little bit of math. You can take maybe your pen and your paper. If, for example, your trading capital is $100, that is what you have put in today, and then you choose a leverage ratio of 1:50, 1 to 50. How much do you have in your trading account to trade with? You'd take $100 times 50, right? So that would essentially be 1, 2, 3, 1, 2, 3, 1, 2, 3, 5,000 USD, is it? 1, 2, 3, yes, 5,000 USD. So now you have access to 5,000 USD on leverage to trade with. But remember, your initial capital is $100. So what we're basically saying is that you should be very cautious when you're taking advantage of borrowed capital, because this is money that basically the broker lends you to have access to higher capital. And it is recommended that while you're starting out and your account size is below $1,000, okay, guys, and I need you to really take this into with a lot of seriousness. If your account size is less than $1,000, that is the live real money in your trading account, then please do not use a leverage ratio of more than 1:50. And I'm going to repeat that again. If your account size is below $1,000, that is in Kenya shillings about 100,000 Kenya shillings, give or take depending on the exchange rate, then please do not use a leverage ratio of above 1:50. It is actually recommended. Some professional traders say you can actually even trade without leverage, because what leverage does, it amplifies your winning trades and it also amplifies your losing trades. So, and we normally say, just to stress on that point, that the higher the risk, the higher the reward. So if you have more profitable trades and you're using a very high leverage ratio, your profits will be amplified or magnified by that leverage. On the flip side, if you have more losing trades and you're using a very high leverage, then it means that the drawdown in your trading account will be in equal measure to that leverage ratio. So up until that, I hope you guys have understood that leverage can work for, and it can also work against you as a beginning trader. It allows you to trade on margin, it amplifies your risk and reward in equal measure. So if you have any questions on computation of leverage, please feel free to type it in the Q&A section. All right, so let's go to our second key discussion point for today's webinar, and that is position sizing. And in this topic, I would like to really talk about risks and reward, given today's topic. Risks and reward. Remember that as a business person, which is essentially what you are doing as a trader, you are in the business of making money. And I like this quote by one of professional traders, and they say that you're not in the business of breaking even. Okay, you're not in the business of breaking even. You're in the business of making money. Ideally, if you put down your risk reward to be, okay, you're looking for your risk reward ratio, risk, which is the capital that you're putting down, and your reward, which is your profit and or losses, because ideally as a trader, you might also incur losses. Your risk versus your reward, the ratio should be 1:2 or 1:3, okay? Meaning that for every dollar or every shilling or every, because I'm sure we may have an international audience, for every euro, whatever currency that you're using, if you risk $1, you're looking to make 2 in return or 3 in return. That is what a professional trader does. And this is what differentiates professional trading from gambling. Okay, your risk and reward ratio. Your risk and reward ratio will determine how much money at the end of the day, if you're a short-term trader, how much money at the end of the week, how much money at the end of the month, how much money at the end of the year that you will be making. And the discipline to stick to this risk and reward ratio is what sustains you in the markets for as long as you want to be in the markets. And because your goal is to be a long-term trader as a business person, then you would be sticking to a risk and reward ratio of 1:2 or 1:3. What does that mean? For every trade that you execute, you need to ensure that you do not also risk, and this is a different point. You do not risk more than 1 to 2% of your entire trading capital per trade. And these risk and reward ratios and these mathematical formulas are what you need to note down for beginning traders. These are what you need to note down, because then if you do not follow these mathematical formulas, which give you a mathematical edge, you essentially would be gambling in the financial markets. So I really hope that is understood. So let us do an example of a trade where you do not risk more than 1 to 2% of your entire trading capital per trade. So for instance, we go back to the same example. Your trading capital is $100. And you're trading this without leverage, for instance. You are not using any leverage, you're not using any debt capital from the broker. So you would do 1% of $100. Okay, that would be 0.01 times 100. That is $1. So that means that you're putting down $1. Okay, for every trade that you take, you should not risk more than $1 per trade. You should not risk more than $1. You can risk 0.05, you can risk 0.02, you can risk any amount, but it per trade, for every trade that you take, it should not be more than 1% of your entire trading capital. And the goal here is to just make sure that you are not using way more capital on every trade and then eventually end up wiping out your entire account size because of allocating the wrong risk, which is essentially your trading capital. So those two rules are very important for you to factor in. All right, so, and I have covered very few things on this position sizing. There is more to that will be covered later on in a practical session. All right, so let us go to the third discussion point, which is marrying risk management with trading psychology. When you look at that photo there, you can see a guy cutting a branch of a tree with his briefcase. And this tree is a demonstration of basically the roots and where it comes from. There's a dollar sign. I like using the dollar sign. So the tree, of course, signifies life and how long this person, for instance, who's on this branch will be. And what I want you to visualize and see with this image is that if you do not manage your risk very well, you will end up cutting yourself off your life as a trader, okay? And yet this tree, which is, take this tree, for instance, to be the markets, okay? The Forex markets, and the Forex markets and how big the volumes move in the Forex markets, okay? So if you do not follow the risk management tools that we have illustrated above from the information above, then you end up cutting up your life, or rather your life cycle in the markets for however long that you will want to be. So if you follow the rules that we talked about earlier on in terms of position sizing and in terms of protecting or preserving your trading capital, the most wisest, or the most, let me not use wise, let me use the word prudent, yeah, let me use the word prudent for accountants in the room. It is wise, it is prudent to test them out on a practice demo account. Okay, as a beginning trader, remember we said the cost of your tuition in the markets is the number of losing trades that you may experience in your live trading account. So what would you do to shorten that cost of tuition and for you to be able to learn the basic concepts of risk management? You would test out the risk management models and tools on a practice demo account, okay, first, before you fund your live trading account. That would be the prudent thing to do for anyone who is putting their money in the trading industry. All right. If you apply the same rules on a live trading account, that is where the work of a trader begins. And that is where psychology comes to play. And the thing is, the reality is you cannot be a trader without you trading in the real life market environment. That goes without saying. Okay, I don't care how long you can be on a demo account. You can be on a demo account for 6 months. You can be on a demo account for 1 year. You can be on a demo account for 10 years, but that would be your choice. Okay, at the end of the day, it is your choice. But for you to be a professional trader, you have to trade on a real life trading account. Okay, and for you to be able to trade on a real life trading account, then it means you have to put down your money on a live account. Okay, for instance, if you have a live account with Scope Markets Kenya. So when real money is on the line, okay, whether that money is inherited, we do not advise for you to trade with inherited money. When real money is on the line, then humans here is you and me, the person attending this webinar, tend to react differently depending on the relationship that you have with money. And when it comes to psychology, there's so much to say, but money is a sensitive resource. It is a sensitive resource. It is a resource, and it is something that you need to live on and to pay your bills, for instance, and to take your children to school if you have children, and to buy your food, and to pay your mortgage or pay your rent. And so people have different relationships with money, depending also on your upbringing, for instance, or on your spending habits, or on your investment habits. All those things come into play when it comes to execution as a trader. So what are we saying? A scarcity mindset will tend out to miss out on trading opportunities. Okay? If your mindset is that of scarcity, then when it comes to execution in the markets, you will tend out to miss on trading opportunities. Okay, if on the flip side, your mindset is that of an abundance mindset, you will tend to seize trading opportunities. Okay, that is how the psychology bit of trading marries with risk management. Now, as a trader, as an individual, as a person, as a corporate, first of all, you need to understand your relationship with money. That's the bottom line. You need to understand your relationship with money. And once you understand your relationship with money, it will affect how you execute on your trades. I actually highly recommend for people who are attending this webinar, if you do not know your relationship with money, either from your own experience, just track how you are when you receive even the little money. It can be either from your income, your salary, maybe you got a windfall from your family or your friend. If your first reaction is to spend that money, then you know that your relationship with money is that of a spender. It's just that simple, plain and simple. Okay? If you have a relationship with money where it has been scarce all your life, money has been scarce, and so you tend to hoard, or you tend to save or invest your entire, whatever amount that you get, whether it's from your salary or from a windfall or from a friend. And so you tend to, what I would say, people, or rather what people say, that some people are misers with their own money. Then you know that that is your relationship with money, and it is good for you to understand that, because then if you understand that, hi Bernard, I'm in the middle of a webinar. Hey Bernard, I'm in the middle of a webinar. All right. Yeah, so what I was saying, sorry about that, guys. If you understand your relationship with money, then you know that you will be able to execute on your trades depending on your relationship with money. And it is also okay to seek for professional help, like a trading psychology, for you to understand your relationship with money, or a professional coach for you to understand your relationship with money. And that basis will be a good background for you to know how to be able to play, or rather to be a professional trader long term. All right. And then a trader's upbringing and childhood experiences may affect his trading performance. However, adhering to risk management rules ensures that you trade up at optimal performance. So that is to say, it doesn't really matter your relationship with money, okay, whether it stems from a scarcity mindset, or whether it stems from an abundance mindset. That really does not mean that you cannot be a trader, and a good trader, and a professional trader long term. What matters is if you are there, if you are disciplined to the risk management tools that we are talking about in this webinar, then you should be able to be an optimal performance trader. And of course, that takes time. So I urge you guys to look at this from a long-term perspective. Okay, if you're a beginning trader, look at trading from a long-term business perspective, and do not look to make a quick buck, because then it will not give you the time that for you to nurture your trading skill, which is essentially sticking to the risk management rules. So being consistent and disciplined to the rules is the way to ensure that you survive in the markets long term. Okay, so I want to demonstrate to you guys how to quickly go to scope markets. Kenya. So you please open your browser. To open a live account, just type in www.scopemarkets.co.ke. And then once you do that, it will take you to the Scope Markets website. Once you're on this website here, you can come here to either if you really don't know how to open a live trading account, there is support that you can call here, okay? And I wanted to take you guys through the different platforms and the different products that are offered by Scope Markets Kenya. So you have shares, you have Forex. Our topic for today is Forex. You have indices, you have commodities, and you have accounts, different types of accounts. So basically, you come here, you choose whatever asset instrument that you want to trade. So for instance, if it is Forex, you choose on Forex. And also you can come here, as you can see, there are shares, Forex, indices, and commodities. And then also, if you really are new to trading, you register here, new to trading. The beauty about Scope Markets is that we have webinars on a daily basis, okay? So when you come to Scope Hub, www.scopemarkets.hub, Scope Hub. Sorry about that. scopehub.co.ke. There. You have access to daily webinars, okay, that you can be able to learn, like today, for instance, and then you can apply this in your trading account. So you don't have to worry about education. You don't have to worry about the basics of getting acquainted to your trading. All you need to do is to make time and create time for you to learn the how to go about it, because then that is why we are here. Essentially, that is why we are here, for you to be able to reach out to us and for us to be able to give you access to that information for you to be able to trade on. All right, so I can see there's one question. What does 1 to 2% translate as lot size, for instance? Okay, we will answer that. All right, so let me go back to my presentation. Yeah, so basically, essentially, that is how you open a live trading account with Scope Markets to trade on different asset classes. And then also you attend of course, there are those Scope Hub webinars every day. And for us, we normally tune in from 2 p.m. on Fridays, that is. All right. So also for future information, of course, you can contact us. That is our website, www.forexstl.com. You can shoot us an email. I would also like to point out that there will be a practical illustration on risk management. For today, this was on beginning classes. So the next webinar that we shall be having, which is next week on Friday, there will be a practical illustration on risk management for different holding periods. And so this webinar registration link that you see here, and I'm gonna copy paste this on the chat section, is what you can use to attend the next webinar here. For you to be able to attend the next webinar, please be using that link to attend the Forex Fridays, as well as all the other webinars that we shall be hosting. All right, so I welcome guys to ask any questions right now. Please type in your questions. All right, so is Scope Market an affiliate of EGM Securities? No, Scope Markets is not an affiliate of EGM Securities. It is an independent brokerage firm, Nagaya Harmon. It was the second licensed brokerage firm in Kenya to be given the license by CMA Kenya. So it is not an affiliate. Those are two different brokerage firms. Okay. So answered. All right. Anonymous, what does 1 to 2% translate in terms of lot sizes? For instance, with a $1, $100, what does lot size to adjust? Okay, so this one will be answered in the practical class, practical session. Please look out for that. Right. Do we pay back the leverage money? All right, Lisa, you do not pay back the leverage money because essentially it is borrowed capital. So it is debt that you are getting from your broker. So the answer to that is no. No, you don't pay back. Don't pay back leverage money. You only use it as a tool to be able to trade. All right, Stephen Kimani, is it possible to trace both indices and Forex in a live account at the same time? Yes, it is possible to trade. It is possible to trade different asset classes in the same trading account. All right. Thank you guys for your questions. I can see more coming in. You're welcome, Nagaya. Okay, is 2% of 100, Emmanuel, is 2% of $100 $2? Is the amount to trade with? Yes, per every trade. So if you're putting down 2% of 100, so per trade on execution, per trade on execution. Absolutely, absolutely. All right, so Ruth Mutahi, doesn't the 1 to 50 leverage limit the pairs that one is able to trade with too much? No, it actually helps you trade more currency pairs. So it does not limit. Leverage basically gives you access to more margin, which means that you will be able to trade more currency assets. All right. I believe that 2% does not include leverage money. Absolutely, James. So absolutely. So that's a ratio that you can use without leverage. You're welcome, Ruth. Onesimus Nzoka, does lot size affect the capital? If yes, which lot size do you recommend for capital of 1 to 100? So basically 0.01. 0.01 Onesimus. 0.01. All right, guys. And guys, we will have a practical session on this. And then Evelyn is asking, what leverage can I start with as a beginner? I answered this question. If your account size is below $1,000, please use leverage of 1 to 50. So there are 1 to 50 for account size above, for account size above 1,000. All right. Can someone make money from risking 1 to 2%? Seems very low. Thank you, Linda, for that question. Yes, you can make money. And we say that Forex trading is capital intensive. So if you have an account size of 10,000 USD and your risk is 1%, then yes, you can make money. However, if your capital size is $100, you can also make money, but very small money. So the thing is, just make sure that you're well capitalized. And that is why we insist on you knowing these ratios and how much money to start with. And the goal here is not for you to make a lot of money in a very short time. The goal here is to make money in a longer time horizon. So yes, you can make money. All right. Okay, so Linda, you're asking, so the better the capital, the better. Absolutely. Absolutely. So it's high risk, high reward. Absolutely. Most welcome, Linda. So let me check if there are any more questions. All right, so there is someone asking, does Scope Markets offer affiliate programs? I don't understand what you mean by affiliate programs, but in terms of offering education, that one is offered. I think that question you can push to support at scopemarkets.co.ke, and they should be able to answer. So thank you so much. If there are no other questions, guys, I would like to ask for everyone to continue tuning in to our webinars, and then more questions shall be answered then. All right, okay, so there's more questions coming in. Do you offer trading signals? No, okay, we're not in the business of offering trading signals, so because then that would be shortcutting your way into trading. So no, we do not offer. We do not offer trading signals. And I'm speaking for STL. We do not offer trading signals. All right. Thank you guys so much. Until the next webinar session, I think that's all for today. All right.